Hi, Howard Deal here with the General Agency, and today I'll be going over gap plans as they relate to group health insurance. Okay, as you've seen in my previous slides, I do color code my slides to make it easy for you to understand. Red is going to be your money, yellow is use caution because it could cost you, and green is the insurance company's money. So what are gap plans? Well, in short, gap plans cover deductibles, co-insurance, and other out-of-pocket expenses associated with your group health plan. Why buy gap insurance instead of an HRA, FSA, or HSA? Well, once again, the short answer is cost. First of all, in the insurance industry, everything is a three-letter acronym, which is TLA. So when you're looking at HRAs, FSAs, and HSAs, I will break those down for you. First, we'll cover an HRA. An HRA is a health reimbursement arrangement. On a health reimbursement arrangement, the employer agrees to pay some or part of the employee's and dependents' out-of-pocket expenses. An HRA must be administered by a third party, and setup fees and monthly fees are charged, and the employer is exposed to unpredictable claims. So on an HRA, an employer increases his or her deductible on the health plan to lower the cost, and in return funds the HRA. So as an example, if an employer agrees to fund $2,000 of an employee's expenses and possibly their dependents as well, when those expenses occur, the employer is expected to pay that $2,000 of that part of their deductible. Now that does have to be administered by the third party because of HIPAA laws. So the claims are pretty much unpredictable. It depends on how healthy your group is and how generous your employer is. Next is the FSA. The FSA is a flexible spending account. This is the use it or lose it account. With an FSA, an employee chooses an amount to be deducted from their payroll pre-taxed, and the employer agrees to front the money when a claim arises. Once again, on this account, setup fees and monthly fees are charged. The importance of the setup fee and the monthly fees is when you're calculating this versus a gap plan, the gap plans don't have setup fees and they only charge a monthly fee, and that monthly fee does include coverage for the expense itself. So hopefully that made sense. But the use it or lose it account, if an employee specifies an amount, let's say it's $2,000 for the year that they want to be put into their FSA, the employer deducts $166.33 out of their pay each month to cover the expenses in that FSA. So over the course of 12 months, that employee would have put in $2,000 into his or her FSA. Now, if the employee does not use the full $2,000, the employer retains the money, whatever's left over. Use it or lose it. Now, on the flip side of that, if the employee does use the money, and it happens to be the first quarter of the year, the employer fronts the $2,000, and then next the employee does not return to work, quits work, or dies because of a result of the accident that caused the claim to begin with, the employer loses the money. So someone loses in an FSA one way or the other, either the employer or the employee. Next is HSAs, health savings account. A health savings account is tax-free money that is deducted from payroll, and there are tax savings to both the employer and the employee. Typically, there's no setup charges for the HSA bank accounts, but they do charge monthly fees in most cases. Some banks will waive the fees if you get over a certain amount of deposits in your account. Now, remember to subscribe to our channel for more detailed information of HRAs, FSAs, and HSAs. So let's take a look at a typical health plan. Let's say that this is your health plan and you have a $3,000 deductible. It's an 80/20 in network plan, and you have a maximum exposure of $6,000. That'd be your total maximum out of pocket for the year. So if you bought a $3,000 gap plan, your gap plan would completely eliminate your deductible of $3,000, and you would just go straight into the co-insurance amount, which is the 80/20, and so your out of pocket expense would then be reduced to $3,000. If you bought a $6,000 gap plan, your deductible would be completely eliminated. The 20% co-insurance that you normally pay would also be eliminated, and your total max out of pocket exposure would be zero at this point. So the gap plans are extremely affordable. If you need a quote, you can always call us here at the general agency and we can get that for you. Gap insurance benefits and riders. So your standard benefits for gap insurance, you have inpatient hospitalization and outpatient hospitalization. Now, most gap plans cover you at 100% of your inpatient hospitalization, but they'll only cover you at 70% if you go outpatient. So it's always beneficial on these plans to be confined overnight, which is worse for the insurance company, but it does cover you at a higher rate. Now, some gap plans, which the ones we sell, will cover you 100% in network and 100% out of network up to your policy limits. So when you're shopping for gap plans, it's always important to look at that outpatient hospitalization, because as you can see that in the yellow writing, it is 70% of covered on most. That you can get 100% of covered expenses for your outpatient hospitalization on some gap plans. So if you have questions on that, be sure and give us a call here at the general agency and we can go over that with you. Now, optional benefit riders. First one that you see there is office treatment rider. These are optional and you don't have to include them in your policy because they do cost money. But the outpatient treatment rider, I'm a big fan of that. The outpatient treatment rider covers 100% of your covered expenses for procedures done in the doctor's office. So some health plans, if you go to the doctor's office and he does a surgical procedure, he or she does a surgical procedure, the procedure itself gets coded as deductible and coinsurance, and because it was done in the doctor's office, some gap plans won't cover that. But with this office treatment rider, they will cover that if it applies to your deductible and coinsurance. So that's a very valuable rider. Next is the durable medical equipment, which is your wheelchairs and crutches and so on. Those riders are very inexpensive. Highly recommend getting that. Cancer treatment center rider. Some gap plans don't cover cancer treatment centers because they don't classify them as hospitals. So if you get a cancer treatment rider, it will be deductible and coinsurance, but your gap plan, if you bought the rider, will cover that facility as well. Next is the independent lab rider. The independent lab rider, if your doctor is doing lab work and he sends it out to a third-party lab, that covers your lab, and that's also very affordable. It's $1 or so as far as the rider's cost. Next is a critical illness rider. Some people love the critical illness rider. I'm not a fan, but if you are interested in critical illness rider, I'll be glad to show it to you as well. And remember to press the like button and leave us a comment. My name is Howard Deal, and if you have any questions, feel free to give us a call at the general agency. Our number is 972-466-2915, and have a great day.